Asian markets rally as Chinese stocks surge 10% after a week-long break. With the US elections nearing, the latest unemployment data boosts market optimism. And we'll examine the state of Lebanon's economy as it faces intensified Israeli attacks. Hello, I'm Taiba Aydin with the latest business and finance news here on TRT World. Chinese markets extended their rally after returning from the Golden Week holiday on Tuesday, before losing steam after a briefing from the country's National Development and Reform Commission. Mainland CSI 300 opened 10% higher, but paired gains to around 5% rise later in the session. The Shanghai Composite rallied more than 6%, while the Shenzhen Component surged 9%, extending a historic rally that started in late September when China announced a sweeping monetary stimulus package to support the economy. Meanwhile, Hong Kong's Seng briefly plummeted over 10% before recovering to a smaller loss of 7%. Other Asia-Pacific markets mostly fell on Tuesday, with investors watching August pay and spending data out from Japan. For more, let's bring in Dylan Wu in Melbourne. She's a research strategist at forex broker Pepperstone. Good to have you with us, Dylan. Now, this is a promising return for markets. Are investors now optimistic about China's economic recovery?
Well, I personally don't think the market is quite banking on a solid recovery just yet. The recent rise in indices since the rate cut announcement, I remember on September 24, seems more about waiting for the NDRC's details on real estate and stock market stimulus today. And we can also see the disappointment reflected in the nearly 8% drop in the Hang Seng today so far. Plus, I think we shouldn't get too carried away with optimism about China's economy, because the ongoing deflation is really tied to a growth model that focuses on production rather than consumption. And also this year, policymakers have mainly pushed for supply chain upgrades, which has just led to more overcapacity. And in simple terms, China's dual speed growth model relies heavily on exports and industry performance, while domestic demand and real estate are struggling. And as we see, there hasn't been much effort from the authorities to change this approach as so far as in today's note. So I personally don't think investor confidence will see a boost.
Right, and as you mentioned, the government laid out further plans for the economy, but stopped short of announcing any major stimulus. Why was that?
Well, because actually the eventual goal of the stimulus push is to tackle deflation, but just relying on monetary easing isn't going to cut it. It needs to be paired with fiscal measures like a re-lending program for the stock market. And the National People's Congress Standing Committee usually reviews and approves this kind of budget during its annual meeting in every March, when most major policy gets finalized. But that said, the NPC Standing Committee meeting coming up in October could probably shed some light on the things like details on swap tools and re-lending plans. So with local governments facing financial strains, we're also hoping the central government could roll out a supplementary budget to expand consumer trading programs and ease local debt issues. So this way, market probably will have a better boost by the sentiment.
Right, and Chinese indices are up over 30% from their September lows, trading well into the bull market territory. Do you expect this trend to continue into the end of the year?
Well, I don't think so, because right now there's a lack of solid policy details from China, and with the upcoming US elections, there are a lot of uncertainties around trade tariffs, investment restrictions, and supply chain risks, etc. And I feel like given that the bullish momentum in the Chinese stock market has been fully played out over the past couple of weeks or half month, I'm keeping an eye on pullback risk in the short term, and probably for Hang Seng, I'll be watching how it reacts around May high. And for the more policy-sensitive CN50, I'll probably pay closer attention to movement near its 50-day moving average.
All right, Dilin Wu, research strategist at Pepperstone, thank you very much for joining us.
Thank you.
Now a quick look at some of the other top business stories from around the world. France's new finance minister Antoine Armand has announced a plan to cut the country's deficit with spending cuts and new taxes. France exceeded the EU's 3% deficit limit, allowing it to rise above 6% this year. Brussels has warned France, putting the country under formal review. Armand reassured EU leaders that France will comply with budget rules. The country aims to reduce the deficit below 3% by 2029 to meet EU standards. Samsung Electronics expects third-quarter profits to rise to $6.8 billion, nearly tripling from the same period last year. But the result is about 12% below market expectations. The company struggled to fully capitalize on strong demand for chips used in artificial intelligence servers. Despite missing estimates, Samsung remains focused on navigating the competitive tech landscape. A US judge has ordered Google to open up its App Store to give Android users more options to download apps and pay for in-app purchases. The judge says the company must allow for greater competition, including making Android apps available to rival sources. The decision follows a jury verdict last year over Fortnite maker Epic Games in their antitrust trial. It's been a year since Israel launched its assault on Gaza. Since then, its military ambitions have grown to include a ground invasion of Lebanon and what it calls targeted assassinations in other territories. But war is expensive and it's having a drastic impact on the economy. Emre Boz reports.
The sound of a continuing Israeli war, which began in Gaza and is now in Lebanon. Country by country, the war machine marches on. It's been almost a year since Tel Aviv began its military assault on the Gaza enclave, and to keep the war going, it's faced some major economic losses. Economic growth shrank 4.1% in the fourth quarter of last year, just weeks after Israel invaded Gaza. And the trend has remained negative, with the economy falling by 1.1% in Q1 and 1.4% in Q2 of this year. One sector that's been hit hard is the tourism sector.
The Israeli economy is reliant mostly on foreign direct investments and tourism at the same time. Tourism is down by, it's almost near zero at the moment. So when it comes to the $21 to $25 billion that it generates per year, it's down to nearly shy of $1.8 billion between 2023 at the end of 2023 and now. So we're talking in 9 months, the tourism sector didn't get in $1.8 billion. They usually get about $21 billion to $25 billion. That's a massive hit.
And the agriculture sector is also suffering. Israeli authorities say that since the start of the war, Israel has faced the largest workforce crisis it has ever known. Leket Israel reports that the production of fruits and vegetables dropped by 80% in the months following the war. And it's being made worse by its war in the north with Lebanon.
This has also halted their agro-industry. That has put a massive hit against the Israelis. They cannot import much of their food and beverages and basically fresh produce from other countries because they have put a ban on the produce that comes from Jordan because of the E. coli. And Turkey had threatened to halt all their fresh produce exports to the Israeli entity. So that has driven also the prices up.
Inflation has been on an upward trend since the start of the year, making the cost of living even higher. And as Israel's war drags on, experts say that this number will keep going up. Emre Boz, TRT World.
Meanwhile, neighbouring Lebanon's economy was already in a state of collapse before Israel started raining bombs on Beirut. Years of political and economic crises had left it indebted, without a stable electricity supply, a proper banking system, and with rampant poverty. More than two-thirds of the population is already living in poverty, and the latest wave of violence is only worsening the situation. Omar Bakkaloglu has the story.
People in Lebanon were already hit by economic collapse and poverty, and as countries rush to evacuate their citizens, they are left to face the brutal realities of yet another crisis. Israeli airstrikes have now pushed nearly 1 million people from their homes.
I never expected we were going to get here. Israel is done with Palestine. They now want to come here too? This is a war. What should I do? It was imposed on us. We were sitting in our homes. We had nothing to do with it. I'm sick and minding my own business, trying to secure an income. No, I didn't expect this, to be living in the streets.
Schools, once filled with students, now serve as makeshift shelters for families with nowhere else to go.
Hundreds of public schools, high schools, and vocational schools, as well as large parts of the Lebanese university buildings and a number of private schools, have been transformed into safe havens that have opened their doors to our displaced people from areas exposed to Israeli aggression. That does not stop at geographical, moral, or humane borders.
But it's not just the displaced who are feeling the pressure. As the conflict spreads across Lebanon's southern and coastal regions, the country's food and agriculture sectors are reeling. Basic goods are becoming harder to find, and prices are skyrocketing.
There is no doubt that the war will lead to rising prices, which may result in a shortage of some products. However, our ministry is addressing the situation in great detail despite the threats and bombings. Some staff members are unable to access the bombed areas. Currently, the bombing has spread to the southern, western, and eastern regions of Lebanon, and the coastal areas have also been affected, extending even to the western Bekaa Valley and the farthest border between Lebanon and Syria.
The country has been in a catastrophic economic situation since 2019, as its economy shrunk nearly 40%. The Central Bank of Lebanon has lost more than two-thirds of its foreign currency reserves during the period, causing banks to halt withdrawals of US dollars. According to the World Bank, the inflation rate has been in triple digits over the past 3 years, after the local currency lost 98% of its value. While the sounds of bombings echo across Lebanon, a quieter crisis is tearing through the country. At least 80% of the population now live in poverty, with little relief in sight. So, the war in Lebanon is not only on the battlefield, it's in every home struggling to make it through the day. Omar Bakkaloglu, TRT World.
Let's get more on this now with Sami Zouraib in Beirut. He's an economist and research manager at the Policy Initiative. Thanks for joining us, Sami. Now, given Lebanon's ongoing economic collapse, how has the latest conflict with Israel further deepened the crisis for the Lebanese population?
Thank you. Of course, there has been major shocks across the different sectors, which have been very much detailed in the reports. I think one key sector that suffered most is definitely the tourism sector, which is a particularly important sector in Lebanon, given the large stock of diaspora that Lebanon has outside of Lebanon that come here and spend money, and that has been the main driver of the economy during the crisis period. The agricultural sector, as you have said, definitely suffers. A lot of the arable lands of Lebanon exist in the south, in the Bekaa region, which have been either bombed heavily or transport routes have been completely stopped. Our export movement has been very much sabotaged by the Israeli aggression, with the bombing of the El Masna crossing towards Syria, which has been invited, which was before the crisis or before this war, a very important source of transporting Lebanese exports to the region, and also making Lebanon important transit points between Europe and the broader Arab Peninsula. And so there has been a lot of damage across. On the level of the humanitarian problem, I think the huge displacement that we have seen and the inability of the government to really address any of the needs of the people has been very significantly palpable. People, as you have seen in the report, really are living on the streets. There has been and not any coordinated effort from the government to really address this issue, and it really boils down to individual initiatives and kind of communal and social initiatives that are done by people, which while are great, they are not enough to address the huge needs of this population. It's important to keep in mind that Israel is literally carpet bombing neighborhoods and cities and towns, which would make them very difficult to come back to. So this is a displacement problem that will probably stick with us way beyond this war ends.
Right, and Lebanon's inflation rate has remained in triple digits for many years now. How does this continued economic instability affect the government's ability to respond to the current humanitarian crisis?
Certainly, the government has been quite ineffective. Did put out a plan to address this problem, which is a foreseen problem. We have been at a similar conflict with, conflict with Israel for the past year that only turned into a very violent Israeli aggression over the past 2 weeks. So we had time to prepare. However, this preparation did not really happen. The government's fiscal capacity now sits at less than a quarter of what it was pre-2019, and that's just to give you the number, that's around $3.5 to $4 billion, which facing the level of damages and the level of needs that exists in the Lebanese economy today is very, very small. Add to it that there has been some kind of a marriage between the fiscal and the monetary frameworks in Lebanon, in which a lot of this fiscal space and public spending is not allowed to happen in order not to add inflationary pressure. And this is a central bank policy. So the government currently has $5.7 billion at the central bank in its treasury account that it is unable to spend because they want to maintain the currency situation stable, which I think is a very bad policy choice. However, this is the one that we have today.
Okay, Sami, Zuhaib, we will have to leave it there. Thank you very much for joining us. Please do stay safe.
Thank you.
As the US election approaches, there is a greater focus on economic data, and the latest positive results on unemployment are giving a boost to markets. The US economy added 254,000 jobs in September, far passing economists' projections of 150,000. This signals a significant boost to the labour market. The unemployment rate fell from 4.2 to 4.1% in September, surpassing analysts' expectations. And wage growth, an important measure for gauging inflation pressures, reached 4% year over year, slightly up on August's 3.9%. On a monthly basis, wages increased by 0.4%, consistent with the previous month's figure. Following the jobs report, the S&P 500 rose 0.9% and the Nasdaq climbed 1.2%. With mixed signals from Bank of England, traders focused on the US economy's strength, favouring sustained growth over aggressive rate cuts. For more, I'm joined by Steve Keen, who is an honorary professor at UCL. He joins us now from London. Good to have you with us. Now, with recent jobs growth exceeding expectations, how sustained do you think this level of job creation is for the US economy in the long term?
Well, ironically, it'll be sustained as long as economists don't get too much dominance over policy setting in America, because what's causing the growth largely is very high level relative to historical standards of the American government deficit. And rather than being a bad thing, as economists think that's a good thing, when the government runs a deficit, it puts more money into people's bank account than it takes out. They have more to spend. That's why the economy grows. So when economists who are obsessed with balancing the budget get in control, they'll actually do damage. And frankly, that's one thing that's quite likely to happen if Trump wins and Elon Musk becomes a major influence on government policy. They'll slash spending on the government budget and actually reduce the economy rather than increase it.
And given the slight fall in the unemployment rate, what impact could this have on the Fed's policies moving forward?
Well, the Fed is run by conventional economists. Again, this is the problem. We have people in control who are seen as experts, who are actually experts on a model of the economy which is false. Their reaction is likely to be to put up interest rates. Now, this doesn't have much effect directly on the American economy because most American mortgages, which are the major form of debt in America, are fixed term. So it's only people who take out new mortgages who are going to face that higher interest rate. And what it will mean is a plunge in demand for new mortgages, but the existing mortgage holders will be unaffected. But on the other hand, the money that's paid, when they put the rates up, what that means is people who hold government bonds get new bonds issued offering a higher rate of return. And in fact, this stimulates the economy even further. So by trying to slow the economy down, their control mechanism is actually speeding it up.
And meanwhile, wage growth has been steady, but inflation pressures do remain. Do you believe current wage trends are sufficient to maintain consumer spending without driving further inflation?
Well, one of the main forms of inflation that applied during the post-COVID period, as Isabella Webb and Blair Fix both point out, was markup increases. And they are now the pressure of that has somewhat fallen. We now have wage rises ahead of the rate of inflation. So that's another positive contributor to inflation. And productivity, at least before we start seeing utterly catastrophic storms affecting America's productivity from global warming, they are likely to recede as well. So there's likely to be slightly higher inflation pressure. But if firms are no longer putting up markups after the huge increase they put through during COVID, I think that might balance any pressure from wage rises.
Right, and the markets reacted positively to the jobs report on Friday. How do you think the US economy's strength will shape investor sentiment as the election approaches in just under a month?
Well, I've seen so many economists, mainstream economists, who of course don't understand why the economy is doing so well, saying they're shocked by how well it's performing and it's actually the best economy in their historical experience. So I think there'll be optimism in the business sector. But whether that translates into votes for the Biden administration and Kamala Harris, I think that's Americans say that's a crapshoot.
Right, Steve Keen, thank you very much for joining us.
Welcome.
And here in Istanbul, many organizations from around the world gathered at this year's summit hosted by Turkey's Central Securities Depository, the MKK. The theme for the event is Bridging Markets, Bridging Continents. Emre Boz was there.
Istanbul is preparing itself to become a hub for the financial markets. Here at the AEC, SD and AMEDA Istanbul Summit, experts in finance and business from around the world are discussing ways to become better interconnected in capital markets. But what are capital markets? They bring international buyers and sellers together to trade assets like stocks, bonds and currencies. And for Turkey, it means the chance to better attract foreign investments. And as finance is made easier, it means Turkey can better trade in the international markets. Transactions become smoother and safer, meaning the profits keep going up. This makes events like this so important for Turkey's economic growth.
Well, that's all your business news for now. Thanks for watching.